Good morning, my name is Przemysław Kwiecień. You're watching weekly trading webinar with XTB. So today we are going to discuss about margin debt signal, a signal that never failed before. So it's certainly the one to watch this time around. But before we do that, traditionally, let's start from things that are moving markets on Monday morning. So yeah, it's a day like every day recently, with fresh records on indices in US and Europe, especially very strong Friday on the German DAX, which we'll revisit in a few minutes, and fresh records on S&P 500 and Nasdaq. What's interesting and what's not normal, I would say, is market ignoring higher US inflation and strong economic data, and despite this, we had this rise in bond prices. So this is something that definitely buoyed market sentiment globally, but this is something that is not normal. It wasn't absolutely surprising because we discussed this last week that Treasury decided for their own reasons to flood the market with cash, and we'll discuss this in a minute as well. Moving on, US imposed sanctions on Russia. Yeah, well, this move is interesting because it might have serious geopolitical ramifications. Certainly, Russia will consider cooperation with China. So we already have some division into blocks, and this geopolitical situation is becoming more compounded. However, markets are in a mood that this is not the news that would have serious impact. We saw the impact on the Russian ruble on that day, but even there it was short-lived, and on the broader markets it wasn't even noticed. So this only shows us how ignorant the markets are right now. We had Coinbase IPO. I mean, sort of IPO. It was actually not IPO, but a listing on the Nasdaq. Coinbase is a cryptocurrency exchange in the US that is a huge success because obviously with this demand and craze about cryptos right now, and with high prices and high fees that Coinbase charges, obviously this is very good for the company. The IPO, the listing was so. I mean, obviously the valuation is still above a combined valuation of New York Stock Exchange and Chicago Board of Exchange. So obviously this is still stunning. However, prices slid a little bit. We can take a look actually at the charts here. So when we go to Coin US ticker, we'll see that after the start of trading, quotations quickly went up, but then they collapsed, and 300 became 310, 315 became a support, and so far this support has maintained the market. However, we'll see how long it's going to last because of the crypto ban in Turkey and rumors of exchange of these bans, not exchange but extending these bans into some other countries actually led to sharp Bitcoin sell-off on Sunday. So it obviously is not positive for Coinbase from that perspective. So far the crypto prices have stabilized, so we'll see if that has a lasting impact. And finally on this page, strong gains in commodities. So obviously with this bond prices rebounding, this helps general everything that is risk prone. So not only records on indices but strong gains. I've listed here palladium, I listed here aluminum, sugar, and you can see that the rallies are there. Yes, sugar is advancing very strongly and looking to test recent highs. Palladium is really looking great because even though, you know, on gold you had this strong recovery here, but it's still in a downward trend. The recovery is still smaller than the one we had at the beginning, towards the end of last year and beginning of this year, whereas for palladium it's upward trend, and yeah, the rally looks to be very, very strong right now. Also aluminium, recently we had some correction, but yeah, look at the opening, it's really looking strong. So this situation on the bond markets certainly helps commodities. Okay, let's discuss quickly what happened last week. Like I said, this is the main story for the markets right now, because we had strong data in the US. We had inflation above forecasts, and we had retail sales way above forecasts, and yet we actually saw bond prices rising. This is explanation what we said last week, that Treasury decided to decrease this bond, this cash position from 1,600,000,000 until, you know, until March to about 500 billion towards the end of June. So they did. We still don't have the latest data because it's weekly data, but it looks like they are really decreasing this cash position very quickly, and that's a big question. You know, so first of all, let's take a look what the impact was. If we take a look at the price of gold and T-note, you will see that these two big rises for both, yeah, gold is red and green, whereas bonds are blue. So you will see that the rebound on gold, and actually on anything else, including Nasdaq, including the other commodities, including euro dollar to lesser extent, but as well, it was driven by a rebound in bond prices. And as you can see, these big two moves on bonds here and here occurred right after very, very strong US data. Here is inflation, here is retail sales. So on paper, it doesn't make any sense, because if inflation is higher, bonds should decline. If retail sales is very strong, bonds should decline, because this takes us closer to a situation where the Fed needs to consider some tapering of QE. So why did it happen here? You know, I don't like these theories, but it looks like it could be some kind of speculation from the Treasury to, you know, to react on the bond markets at that point to mislead market participants. I mean, there is no other logical explanation, and furthermore, there is no logical explanation to this cash position decline, because, you know, there are huge deficits that needs to be financed in the future. So why would you not roll over short-term bills and splash the market, splash cash on the market, whereas in a few weeks' time you need to borrow much more? It doesn't make any sense. So unless there is something we don't know, like a secret deal with the Fed or something like this, it doesn't make sense. And if the Treasury needs to borrow heavily in the months ahead, they will do exactly the opposite to the market. They will withdraw this liquidity and cause market correction. So yeah, we'll see. You know, we're definitely going to track it. There is this story doesn't receive enough coverage, but we try to track it, and if there's anything we can share with you, we'll publish this on the news section. I try to discuss this at these webinars as well. All right, let's move on to the story of the week, which is a Wall Street signal sent by margin debt. So what is margin debt? Margin debt is a very simple thing. If you buy stocks, you can get leverage from your broker. I mean, this is for US, of course. So it's usually up to 2-to-1. So if you deposit $10,000, you can get this margin to buy stocks for up to $20,000. So first of all, why would you do that if you don't know what to do with your cash? Well, you know, this is standard. The market is ruled by greed and fear, and you know, if stocks seem to be only go up, why not to double down and, you know, increase your exposure if interest rates are zero, or of course this margin has some interest, but it's still pretty low, and these gains on S&P 500 are so strong and so consistent. So yes, so this is so people are taking on this margin debt, and it's actually very interesting indicator, because first of all, the data is covers more than 6 decades. Second, it's very accurate indicator of sentiment, because you can have some soft indicators like questionnaires, and you can ask people, are you bullish, are you bearish, but actions do tell us more than words. So if they are taking this margin debt, it means that they are bullish, and on the extreme it might be contrary indicator. And secondly, if a deep correction arrives, they can get a margin call, so they will need to sell, or the broker will sell their stocks in order to cover this margin. So this is important indicator. As you can see, as I said, the data spans for more than 6 decades. However, for a long time, this variation in this margin debt was limited. For a few decades, this margin debt was really subdued, below 1% of the GDP. Probably because it was only limited to some hardcore, more professional traders, but it started to rise very, very quickly in the 90s, and as you can see, approaching 3% of the GDP in 2000, 2007, and then the last decade was usually a warning signal. But right now we are already close to 4% of the GDP, and obviously 3% didn't impress markets really. But what is more interesting than just a level is an annual change, which, as you can see, is more stationary, which means it's moving in a more stable way, right? So you have lows and peaks that are more kind of regular. Of course, it's not very regular because there is no such thing on the market, but you only had 3 situations in the past where these gains in margin debt to GDP were of about 60%, and each time they warned us about some incoming market decline. So let's take a look at these 3 situations, and of course right now we have another increase like this, or actually even stronger, so slightly stronger. So it looks like it's the 4th time. Obviously there is no guarantee that it's going to have similar consequences, but let's take a look at these 3 situations. So first of all, in 83 and 84, it only warned us about a small correction. The market was recovering from a very painful double dip recession, and stocks were incredibly cheap by today's standards. So there was only this increase in margin debt led to sharp rally, as you can see here, nearly 70%, and then there was about a correction slightly more than 10% from the top, and then market kept return to the rally. But more interestingly, in 2000 and 2007, actually the signal occurred slightly before the high, especially in 2000. As you can see here, the signal was about 10% below ultimate market peak, which also occurred twice, nearly 3 times here. You can see there was no single peak in the dot-com bubble for S&P 500, but then obviously what we had in both situations in 2007 and 2000 was obviously very painful bear market. So how is it now? So obviously the signal, because the data is monthly and it represents some past situations, there is some delay. We had a signal at the beginning of March. So since then, obviously the markets already took off a bit like in 2000, and obviously looking at the other indicators like S&P 500 to GDP, like margin debt to GDP, which I already showed you, like price to earnings, like price to sales, markets are the most expensive ever. All these indicators are at the record levels. Only investor sentiment, as measured by the survey, is not at the record although is way above the median. What does it mean? It means that there is high, this is a warning signal. If you are a stock investor, if you have portfolio of stocks, you should bear that in mind and consider reducing your risk, because something might happen, at least a correction. Of course, when it happens, it's a big unknown, and this signal doesn't tell us this. Moreover, it's just the fourth time, and what's nice is that here we don't have a situations where we had this increase and no repercussions. So in all three situations there was at least one correction and two bear markets, so there were no false signals, but the number of these signals is obviously very scarce. So obviously we don't know for sure, it's not physics, but the warning sign is there. However, it's not a short-term speculative signal. If we look at indices from the short-term perspective, we actually can see that they remain extremely bullish. Let's take a look at the DAX, which remain in upward channel, and not only did not react here because there was some consolidation, but actually used this upper bond of the channel as a support and bounced so much higher on Friday. So right now, just like here, yeah, we had consolidation and a trigger upwards. Here, consolidation, trigger upwards. So this market is so strong that trading against this would be very dangerous at this given moment. There is no bearish signal here. Similarly, S&P 500. Let's take a look at M15 interval. And we can see that you can use 350 moving average as a support, and what you actually should do short term is to join the trend rather than trade against it. So once again, all the fundamental indicators, they are showing us broader picture, but short term wise there are no signals that would tell us to correction is or even more, something more is coming. Also, if we look at the on the day one interval, we also see for S&P 500 that we are in a kind of megaphone formation, similar to something that we had in a pre-pandemic. And while obviously the pandemic was something very unusual, and you could say, well, this chart looks similar. We had some market gyrations here, like here, and then this megaphone like here. So yeah, the market needs to go down. But like I said, even though we had fundamentals behind it, short-term signals are missing, at least for now. All right, so let's move on to the present week. This week is going to be fairly busy, but a lot of indicators, I would say, are kind of second tier. UK, lots of UK data, but it's for March, so we already know what's the inflation picture. So it's only going to impact the GBP, the British pound at most. We have Bank of Canada decision Wednesday. We have ECB. Like I said, second tier. Well, ECB is already second tier to me, because what could they do right now? They already are going at full speed with balance sheet expansion, interest rate, and so on and so forth, and with the data improving slightly in terms of inflation, with vaccination progressing in Europe, I think the ECB will just stay pat. So even though it's normally important event, I would say this Thursday, not so much. I would be more eager to track Friday, where we have PMIs from Japan, from Europe, from US. So these are flash signals for April. So I would say this is more important. And obviously, earnings season on Wall Street, a lot of reports. We don't have the biggest names this week, but markets will be looking at Intel, for instance, with these chip shortages. So certainly something. And another factor, another event that is actually feeding the bull market, because with these earnings seasons, it's usually like the consensus is set low. So we get beats and beats and beats. And with this sentiment, where, as I said at the beginning, the markets ignored, for instance, sanctions on Russia, but they are very eager to react on every bit of positive news. So this earnings season might be just another bit of fuel helping it. Okay, so this is it for today. Thank you for your attention. Please stay with us using the news section on Xstation mobile platforms, where we try to share all the data releases, all the technical patterns on a continuous basis. So I think it's very useful tool to boost your trading, and we'll see each other next Monday at 7:30. Have a great week.